Whenever the sound of war erupts anywhere in the world, not only is the sky torn apart by bombs and bullets, but the global financial markets are also violently shaken. In that moment of chaos, one question always arises in the minds of investors, large financial institutions, and those monitoring the world economy: where will the money flow? Will power shift toward the US dollar, considered the king of the global financial system, a familiar safe haven whenever instability arises, or oil, a vital energy source, likened to the lifeblood nourishing the entire world economy? This is not just a comparison between a currency and a commodity, but a confrontation between market fear and the survival needs of the economy. Every time war breaks out, from the Middle East and Europe to other geopolitical hotspots, both the USD and oil prices tend to surge. But the extent of the increase reflects a completely different story. When investors panic, they tend to sell off stocks and risky assets and quickly shift capital to the USD as a safe haven. This causes the greenback to often jump very quickly in the first hours of a crisis. But conversely, if hostilities occur in areas that significantly impact global energy supplies, especially the Middle East, which holds most of the world's oil reserves, then oil prices can explode in a very short time due to fears of supply disruptions. Just a threat to a straight shipping route, a blockade of a major exporting country, or the imposition of sanctions can cause oil prices to jump by tens of %. Therefore, the battle between the USD and oil during wartime isn't simply about who is stronger, but rather who reacts faster to market fears and who is more directly impacted by the nature of the conflict. There are times when the USD surges as money seeks safe havens. But there are also times when oil outperforms due to supply constraints. And that's what makes the question, USD or oil, who rises stronger when war breaks out, a fascinating topic not only for investors but for anyone wanting to understand how the world operates during times of instability. Whenever the world enters a period of instability, whether it's war, a financial crisis, or global geopolitical events, the first reaction of capital flows almost always follows a very familiar pattern. Investors immediately withdraw capital from risky assets and seek what they consider to be the safest haven. In this picture, the US dollar almost always emerges as a safe haven, the first destination for global capital flows whenever fear grips the market. This is not accidental, but the result of decades of accumulating economic and financial strength and the world's confidence in this currency. The USD is not simply the currency of the United States, but also the world's largest reserve currency, used in most international trade transactions, payments for strategic goods, and foreign exchange reserves of central banks. Therefore, whenever a crisis erupts, the market's first instinct is to return to the US dollar as a lifeline in the storm. Imagine the psychology of investors during times of global upheaval. When news of war emerges, stocks typically plummet, and risky assets like equities, cryptocurrencies, and speculative commodities are heavily sold off. At that time, what investors need most is not high returns, but safety and the ability to preserve the value of their assets. And the USD perfectly fulfills that role. This is what the financial world calls flight to safety, meaning money fleeing risk to find a safe haven. In moments of peak fear, investors are willing to sell assets with long-term profit potential just to hold an asset that is more stable and liquid. The USD, thanks to its central position in the international financial system, is almost always the number one choice. Looking back at history, we see this pattern repeating itself many times. During the 2008 global financial crisis, when the international banking system teetered on the brink of collapse following the global financial crisis, stock markets worldwide plummeted unprecedentedly. Investors from all over sold off assets to hold cash, and a large portion of that money flowed into the US dollar. Although the crisis originated in the US financial market, paradoxically, the dollar still strengthened significantly because it was the world's most reliable safe haven during times of turmoil. This demonstrates that the strength of a currency lies not only in the underlying economy but also in the level of confidence the global market places in it. Similarly, when the COVID-19 pandemic erupted in 2020, fear stemmed not only from health issues but also spread to the economy, trade, and finance. In a short period, major stock indices plummeted, oil prices at one point fell to historically negative levels, and investors around the world flocked to the USD. In the first weeks of the pandemic, the DXY index, a measure of the USD's strength against a basket of major currencies, surged significantly. Once again, the safe haven rule was clearly demonstrated. When things become unpredictable, the USD becomes the first place money flows to, not only during financial crises or pandemics, but also during wars. The USD's strength is a frequent factor in the initial stages. A prime example is the conflict between Russia and Ukraine. When hostilities broke out, panic immediately gripped global financial markets. European stocks weakened, the euro came under downward pressure, while the USD surged due to its safe haven status. This reflects a crucial truth. In times of instability, investors seek not maximum profit but maximum certainty. And in the modern financial world, few assets offer the same strong sense of certainty as the USD. Another factor contributing to the USD's enduring role as the king of safe havens is the strength of the US economy. The United States remains the world's largest economy with a deeply developed financial system, a massive bond market, and leading global liquidity. When investors hold USD, they are not just holding a currency, but are essentially gaining access to the world's largest financial ecosystem, from government bonds and money markets to other risk hedging instruments. This is why, even when the US is at the center of turmoil, the USD can still appreciate. However, it's noteworthy that the strength of the USD in war is most evident in the early stages of a crisis, when fear and uncertainty are high. In the long term, the currency's performance depends on many other factors such as interest rates, Federal Reserve policy, economic growth rate, and the extent of the conflict. But under any circumstances, one thing remains almost constant: whenever the world descends into chaos, the USD is always the first destination for global capital flows. Therefore, calling the USD the king of safe havens is not just a figurative expression, but an accurate reflection of its role in the history of global finance. In times when confidence is tested, wars shake the economy, and markets are engulfed in panic, the greenback always emerges as a symbol of safety, liquidity, and confidence, three core elements that every investor seeks when a storm begins to brew. Not only during financial crises or pandemics, but also during wars, the USD's strength is a frequent factor in the initial stages. A prime example is the conflict between Russia and Ukraine. When hostilities broke out, panic immediately gripped global financial markets. European stocks weakened, the euro came under downward pressure, while the USD surged due to its safe haven status. This reflects a crucial truth. In times of instability, investors seek not maximum profit but maximum certainty. And in the modern financial world, few assets offer the same strong sense of certainty as the USD. Another factor contributing to the USD's enduring role as the king of safe havens is the strength of the US economy. The United States remains the world's largest economy with a deeply developed financial system, a massive bond market, and leading global liquidity. When investors hold USD, they are not just holding a currency, but are essentially gaining access to the world's largest financial ecosystem, from government bonds and money markets to other risk hedging instruments. This is why, even when the US is at the center of turmoil, the USD can still appreciate. However, it's noteworthy that the strength of the USD in war is most evident in the early stages of a crisis, when fear and uncertainty are high. In the long term, the currency's performance depends on many other factors such as interest rates, Federal Reserve policy, economic growth rate, and the extent of the conflict. But under any circumstances, one thing remains almost constant: whenever the world descends into chaos, the USD is always the first destination for global capital flows. Therefore, calling the USD the king of safe havens is not just a figurative expression, but an accurate reflection of its role in the history of global finance. In times when confidence is tested, wars shake the economy, and markets are engulfed in panic, the greenback always emerges as a symbol of safety, liquidity, and confidence, three core elements that every investor seeks when a storm begins to brew. If the US dollar is a safe haven for money during times of global turmoil, then oil is a direct reflection of the pulse of war. Oil is not simply a commodity traded on the international market, it is the lifeblood of the entire global economy. From cars on the road and planes taking off into the sky to cargo ships crossing oceans and massive industrial factories, almost every modern economic activity depends on the energy that oil provides. Therefore, whenever war breaks out, especially in strategically important energy regions like the Middle East, Oil prices not only rise but can also explode dramatically within the first few hours. Unlike the USD's rise due to safe haven demand, oil prices rise for a much more practical and frightening reason: the fear of supply shortages. The oil market operates based on expectations of future supply and demand. The mere threat of escalating hostilities in oil production or shipping areas triggers a reassessment of risk by investors. This means that oil prices don't need to wait for actual supply cuts to rise. The mere fear of such a situation is enough to drive prices up sharply. This is what makes oil a particularly powerful economic weapon in wartime. When oil fields, pipelines, export ports, or strategic shipping lanes like the Strait of Hormuz are threatened, the market reacts with immediate panic. Approximately 20% of global oil passes through this region, so any tension there can cause a massive surge in oil prices. Recent developments in the Middle East have pushed oil prices above $100 per barrel again, demonstrating that escalating geopolitical risks trigger an immediate reaction in energy markets. History has proven this repeatedly. During the Gulf War, when conflict erupted in the Gulf region, considered the energy heart of the world, oil prices surged dramatically in a very short time. The reason wasn't that the war increased oil demand, but rather concerns about disruptions to supply from the planet's largest oil-producing region. As hostilities approached key oil-exporting nations, the market no longer viewed oil as a mere commodity, but as a strategic asset vital to the entire global economy. And here's the most important question, and the point of confusion for many when monitoring the market during wartime: which will rise more, the USD or oil? In reality, there's no single answer for every situation, as the extent of each increase depends entirely on the nature of the conflict. If war occurs in strategically important energy regions, especially the Middle East, considered the world's oil supply hub, then oil is usually the asset that rises more sharply. The reason is clear: even a slight risk of supply disruption can cause oil prices to surge by tens of percent in a short time due to fears of shortages. In this case, oil reacts directly to the real-world risk of commodity markets, so the rate of increase is usually stronger and more dramatic than the USD. Conversely, if war leads to a financial crisis, widespread panic in the stock market, and investors collectively seek safe havens, then the USD tends to rise more sharply. At that time, global capital would withdraw from risky assets and pour into the US dollar as a safe haven, causing the USD to surge rapidly in the initial phase. In other words, oil prices rise sharply when war threatens energy supplies, while the USD rises sharply when war increases fear across all financial markets. Therefore, to determine which is stronger, the important question is not whether war will occur, but whether that war will have the strongest impact on energy supplies or on global capital sentiment. When war breaks out, the question many investors, financial institutions, and those interested in the global economy always ask is, in the midst of this chaos, will the USD or oil rise more sharply? In reality, the answer is never absolute, because the extent of the increase in each asset class depends entirely on the nature, scope, and duration of the conflict. There are times when oil surges, far outpacing the USD, but there are also periods when the greenback becomes the most prominent appreciating asset. The important thing is to understand which aspect of the global economy is most strongly impacted by war. If the war takes place in strategically important energy regions, especially the Middle East, considered the heart of global oil, then oil is almost always the asset that reacts more quickly and strongly. The reason is clear: war in this region not only has geopolitical significance but also directly threatens the world's energy supply. The mere threat of an oil field attack, a pipeline sabotage, or a blockade of a vital shipping lane like the Strait of Hormuz can cause oil prices to surge dramatically in a very short time. The market doesn't wait for actual supply cuts to react. As soon as concerns arise, prices begin to climb. This fear of supply shortages can cause oil prices to rise by 20%, 30%, or even 50% in just a few days if tensions escalate rapidly. Meanwhile, the USD also rises as investors seek safe havens. But the increase is usually slower than oil because oil directly reflects the physical risks of the global economy. In other words, in wars that significantly impact energy, oil is often the clearer winner. However, the picture would be completely different if the war didn't just stop at a single hotspot but spread into a financial crisis or caused widespread panic in the markets. In this scenario, the US dollar typically rises more sharply than oil. The reason lies in the psychology of global money flows. When war causes stock markets to plummet, investors begin selling off risky assets such as stocks, cryptocurrencies, and speculative commodities, and shifting capital to cash, especially the US dollar. This is a very familiar reaction whenever the world faces instability. Money seeks safety. The US dollar has long been considered the world's #1 safe haven currency due to its position as a global reserve and the strength of the US economy. In this context, the demand for holding USD surges, causing the value of the greenback to rise very quickly. Conversely, oil prices don't always rise sharply. If war leads to an economic recession or causes global production, transportation, and consumption to slow down, the demand for oil will decrease. This could cause oil prices to rise weakly, remain flat, or even fall during certain periods. Even though the war is still ongoing, this is the core difference. Oil surges when supply is threatened, while the USD surges when market sentiment is threatened. A more complex scenario, and one that often occurs in reality, is a war that lasts for months or years. In that case, both the USD and oil could rise, but in completely different cycles. In the early stages, when news of war first breaks out, the market's initial reaction is usually fear. Investors immediately flee risk and pour money into the USD. Therefore, the greenback is often the strongest performing asset in the first days of a crisis. However, as the war drags on and begins to significantly impact the supply of goods, especially energy, oil becomes the more resilient asset. At this point, the market no longer reacts solely to news but begins to assess the actual impacts on the economy. Supply is constrained, transportation costs increase, production stalls, and inflation escalates. These factors drive oil prices higher in each phase. Simply put, the USD reflects immediate fear, while oil reflects the real economic impact of war. Interestingly, in many cases, the appreciation of both the USD and oil can occur simultaneously, creating a double pressure on the global economy. When the USD strengthens, countries have to spend more of their domestic currency to import oil, while the price of oil itself is also rising due to supply risks. This leads to more severe inflation, especially in countries heavily reliant on energy imports. Therefore, understanding which appreciates more significantly is not only important for investment but also helps to see the far-reaching impact of war on the entire economy. Ultimately, the answer to whether the USD or oil appreciates more when war breaks out lies in the very nature of the conflict. If war directly impacts energy supplies, oil prices typically rise more sharply and rapidly. If war triggers a financial crisis, panic buying, and economic recession, the USD is likely to be the stronger performing asset. If the war drags on, both could rise, but each reflects a different phase of the crisis. The USD rises due to initial fear, while oil rises due to increasingly evident economic consequences. This is precisely why monitoring war developments is key to understanding the direction of global capital flows. One fact that few people notice when monitoring market fluctuations during wartime is that, under normal circumstances, the USD and oil prices typically have an inverse relationship in the long term. Simply put, when the USD strengthens, oil prices tend to be restrained or rise more slowly, because oil is primarily priced in USD on the international market. When the dollar appreciates, countries using other currencies have to spend more to buy the same amount of oil, which can weaken demand and put pressure on oil prices. Conversely, when the USD weakens, the cost of buying oil becomes more affordable for importing countries. Consumption tends to recover, and oil prices are more likely to surge. This is a familiar rule that seasoned investors often use to analyze market trends. However, the unusual thing is that when war breaks out, this seemingly logical rule can be completely broken. During that time, the market no longer operated according to familiar patterns of technical analysis or long-term correlations, but was strongly influenced by emotions, fear, and a constant stream of news. Investors no longer looked at charts or indicators as usual, but reacted to the risk of escalating hostilities, supply disruptions, and global instability. Therefore, there were times when both the USD and oil surged simultaneously, something rarely seen under normal circumstances. In other words, when war breaks out, fear often outweighs market logic, and news often carries more weight than any trend line on a chart.